Want to see someone systematically disprove everything you have read about trading stocks and expose how and why you will consistently lose money if you aren't doing it right? Click the link in the description to check it out for yourself. But now for today's video.
The question, why don't people sell put options rather than buy stocks? Answer by Kevin McElroy. There are some problematic and misleading answers to this question. First, selling puts is a great strategy if you follow two rules. Only sell puts on stocks you want to own at the price you want to own them. If you follow this rule, you'll only be getting paid to do something you want to do. Win-win. Only sell puts up to the amount of capital you want to risk. One option equals 100 shares, so don't be greedy. I typically only sell 13 contracts at a time. There are some other simple guidelines to help you execute successfully, like only going out 3,060 days, and shooting for at least 2% premium on risked capital, but by and large, these rules will keep you safe. To blow up some myths about put selling, selling puts under these circumstances is less risky than buying the stock outright at the current bid. That's because you're risking less capital to make the same transaction. Read that again. A put writing strategy. Following these rules entails less risk than buying the stock outright. The way I sell puts, I'm hoping the stock hits my strike price. If I've done my homework, I know I'm buying a great company at a great value, and I already got paid for the privilege. Whenever I can, I sell puts to get into a company. Sometimes that means that a stock runs away from me, but even in that case, I still got paid. And as they say, opportunities are made up easier than losses. I can always recalibrate my buy price and sell puts again next expiry. To answer the question, I think most people don't sell puts, or trade options generally, because they don't understand how options work. It's easy to understand that stocks go up and down, and there are basically only two transactions you need to understand if you're a shareholder: buy to open and sell to close. Most people don't short shares, but with options, there are 8 different transaction types. Buy a put to open. Buy a put to close. Sell a put to open. Sell a put to close. Buy a call to open. Buy a call to close. Sell a call to open. Sell a call to close. That's a lot more to wrap your head around, and most people don't have the time, patience or inclination to do the modest legwork to get an understanding of the process. And it doesn't even include the myriad options strategies that involve more than one type of option. I'd add one more reason why people don't sell puts, or trade options in general. They're scared away by people peddling misinformation that makes options sound far riskier than regular shareholdings, and that's a shame because options can minimize risk if used correctly. Answer by Sudhir Petty. All stocks that are traded on the exchanges are not included in the derivative segment. Writing put options require paying margin money and maintenance margin till the expiry or till the position is squared off. If I want to buy 100 shares of Reliance Industries shares, I just have to pay the required amount of about 89,000 rupees, take delivery and keep them as long as I would like to. For that I need not sell a put option of Reliance Industries contract which contains a minimum of 1,000 shares by placing about 125,000 rupees margin amount. Writing options is an unlimited risk, though with high probability of success but with fixed return where the gains that can be made are limited to the premiums received. Even when we are successful in 90% of option writing trades, remaining 10% failure trades more than wipe out whatever we could have made by writing the previous successful option trades. Put option sellers do not receive dividends, they will not have had any voting rights, they will not have any capital appreciation, etc., etc. These are some limitations and risks involved in writing options. Answer by Mark Montoya. Because options can make money even if you are wrong about direction, there is also the leverage factor. You can often control a significant amount of notional value for pennies on the dollar. The inverse of the delta is a good way to measure the risk, so if you are risk adverse and have lots of buying power, you sell the 10 delta puts. These have approximately 90% probability of being worthless. When you buy a stock you don't have a 90% chance of making a profit, as it's always 50-50 proposition. If you want to own a stock, sell a delta closer to the money. If you get put the stock, great. If you don't, you made a lot more than selling deep out of the money. I personally think owning stock is a waste of capital, unless you are retired and need dividend stocks for steady income. About 80% of the time stocks chop around and basically go nowhere, and trend up/down the other 20%, so this is just more support for selling puts.